Welcome back to another episode of Profusion. Today we've got the great Adam Coffey. We already drank coffee together before. How's it going, Adam?
Good to see you, Andrew. Hello to all your listeners out there.
Yes,
it's a pleasure to be on your show. We've known each other for a while, and
I think a couple of years now. Thanks for coming on. And I like to get credentials out of the way right away. I want to capture everybody in the first minute. And so you have written 3 best-selling books. I've got them. I just gave them to my assistant to read while we're doing the podcast. But are they best-selling on Amazon, Wall Street Journal, USA Today? What are they at?
Vast majority of book sales are through Amazon in the world. All of mine are #1 global bestsellers on
Amazon. So you got 3 best-selling books. You were the CEO. You worked at General Electric for how many?
10 years. 10 years.
10 years. And then you were the CEO of Wash Multifamily. Go. Help me out.
Okay. So, background, military, taught me something about discipline, teamwork, leadership. Engineering made me a meticulous planner. Jack Welch taught me how to run a business. And then I spent 21 years as a CEO of 3 different large national companies. I built them for 9 different private equity firms. I bought 58 companies doing buy and builds, and I have 2.4 billion in career exits as a CEO, and have 3 #1 best-selling books. 4th one coming out in 2 weeks, and so or at the end of the month, rather. And so it'll be out on the book stands here soon. I got bored. I decided a couple of years ago to hang up my cleats, stop being a CEO, stop building one company at a time, and start working with multiple companies at a time. So I work with about a dozen PE firms. I do operating partner style work. I sit on their boards. I mentor and coach their CEOs, help them evaluate investments. And I'm working with 68 founder-led companies right now. 38 of them are in a peer group that I do with a business partner, JT Fox. It's called the Chairman Group. And then the rest are private clients or just individual clients that I work with. And, I still teach seminars, write books, doing all that kind of stuff. But I'm having fun. That's the most important part, Andrew. I just turned 60. And I decided for the last 10 years of my career, instead of building one more company, I'm going to help as many entrepreneurs find success as I possibly can.
So to serve is your goal, just like in the military, was to serve others. Is that correct?
Well, I'll make my money along the way. So I'm not a nonprofit or a charity, but I decided that it's funner, and the real gist of it
is funner a word?
Yeah, well, it is now, so when I think of running one company and being responsible for tactical execution, that's where the mundane boredom comes from. When I'm working with 68 founders, I'm helping them with strategy and, with tactical plans of execution. But they ultimately own, I'll call it the actual day-to-day tactical execution of the plan. So I'm being more strategic. I'm higher level. I don't get bogged down, with thousands of employees. She said this, he touched her. It's like I don't have all that crap that goes with running a company. I just have the fun of being a strategic, commander who helps somebody win the war.
So would you consider yourself smarter than all the ones that own the businesses?
No, because I think there's a time and a place for that, and it's like, in my younger years, I certainly enjoyed doing it. But after 21 years, I needed a new challenge. It was just kind of getting boring. Getting up every day, doing the same damn thing. And, while the outcomes were great and, literally, PE firms made billions, it just wasn't fun after decades. I needed a new challenge. And so
making money isn't fun. Interesting.
Yeah. Well, you can still make money, but have fun. So you can make money and not have fun, or make money and have fun, right? So it's like I decided.
Well, couldn't you figure out how to have fun in doing it that way, though?
Well, I kept trying to extend my useful life as a CEO, and it just eventually just got to be mundane. Think about a professional athlete. It's like at some point, it's like it's time to move on to something different. And so I decided that I could help up and coming executives. When I was doing research for my book, Empire Builder, I came across some stats, 34 million small businesses in America, but only 7% ever get to $1 million in revenue. and only 4% of those ever get to 10 million in revenue. And I'm like, why the hell is it so hard for people to find success? And so as a guy who's built billion-dollar businesses, I decided, let's teach. And I had been teaching for 15 years. So, at UCLA and other places. And so I really enjoyed, kind of the giving back, the mentoring part. And I just decided, I used to do all that stuff for free. And, my CEO stuff is where I earned a living. So I decided, how do I flip my paradigm and become a mentor and teacher to many, but monetize it, and then let go of the stuff that I'm not having fun doing after 20 some odd years.
Then how did you do it? Because I know JT Fox, he's into social media. Did you just like hire somebody in social media? Because it's not that easy to flip, really, right? You have to have a lot of faith.
Well, JT certainly was instrumental, and I dedicated Empire Builder to him. Like all my books, they started as college lectures, or they started as seminars. Things that I was working on. And then eventually they wound up, getting memorialized into a book. But what I did is, just like I did any other kind of business, I just went heads down. Okay, like literally the day after I stopped being a CEO. While I may have a high net worth that could produce a lot of cash flow, I'm like, I'm too young to live off of, call it my portfolio. It's like, okay, I need an income. I need to solve for cash flow. And in life, there's two issues. One issue is we need to solve for cash flow. What does our lifestyle cost? How much capital do we need just to cover that? Second issue is I want to build wealth. I've got the wealth box checked. Tons still. My biggest paydays are still ahead of me. So illiquid investments, rollover investments in private equity funds, they're all still out there. Over the next 5 to 10 years, those convert back to liquidity and come back to me. So the wealth generation part, box is checked. So I woke up the next day and said, it's time to solve for cash flow. So started a company, built a website, heads down, started marketing. And if you talk to all of my clients, that I do business with today, and JT's about 25% of my empire, about 75% is outside of JT. Really, it's, if I ask all my clients, how'd you find me? I read your books. I heard you on a podcast. So I've been on hundreds of podcasts, and they're all out there. They live in the digital world forever. And so I call them buoys, and they're floating around in the ocean of life, and people are out there bouncing into them. And when they hear one, maybe they try to find another, or they come to LinkedIn and they follow me there, or that leads them to books, or they read a book that came to a podcast. It's like, that's my pinball machine that brings me, I'll call it clients that I'm working with today, is they read my books, they hear me on a podcast, and then they come. And so as a result of that, I do a lot of podcasts, and I continue to write, teach seminars for global audience. And then JT, certainly helped me from a seminar perspective. So I had been teaching for years, but not monetizing it. So with JT, with his promotion skills, one of the world's
you were teaching at a college?
I was teaching at universities, and not full courses. I was a full-time CEO, so I wasn't an adjunct professor teaching an 8-week class, or a 13-week class. I was simply a guy who was being a guest lecturer, working with different professors, and always on the subjects of private equity, turnarounds, and alternative investments, leadership, just kind of generic subjects and topics. But I really enjoyed that, and so I remember the first seminar JT and I did, was probably a million plus in revenue. So that opened up a different world to me that I had not, I knew of it, but I had never really participated in it or pursued it. And so JT and I partnered up, and we do, multiple seminars a year, and we do some other stuff together. And so, it's like you put together the building blocks, the work I do with private equity, because I was well known in the private equity world. And there were some other people who were key and instrumental to introducing me to a bunch of different firms that I didn't have relationships with, who are now clients of mine. And then there's the call it the private client, the coaching, the mentoring, working with entrepreneurs one-on-one. And then you add in the seminars, the peer group stuff that I'm doing. And it's like, those are the three kind of verticals.
So how many people are you mentoring right now? Did you say 68?
Yeah, there's 68 people, who are all founders that own companies of
then you
various
have
size.
Chairman's Club. Is it Chairman's Group?
Chairman's Group has 38 founders.
You've got 100. You're working with 100 people on a regular basis. So give us
the 68 includes the 38 that are in the chairman.
A lot. You're networking internationally, nationally, around the country. So give us a macro perspective on private equity or M&A right now.
Yeah. So look, hey, interest rates have been higher. I won't say high because they're not high in historical norms, or terms, but they're certainly a lot higher than they've been in the last 10 years. And so we've gone from a low interest rate environment to a little bit higher interest rate environment. That allows for less leverage or debt. So, back in my heyday, call it, of private equity, very typical to buy a company and use 50% debt, 50% equity. Nobody bothered, to think that was, if you're buying a house out there and you can put down 50% equity, no one feels bad. They don't think they're over levered. They feel really good about the equity they have in their house. And that's what private equity was doing. But as interest rates have ticked up, there was I call it a game of chicken that got played, about a year and a half ago, where, founder expectations due to low interest rate environments were very high. I want high prices for my companies. PE expectations were, well, I can't lever as much debt and I'm not writing a 60, 70% equity check. So, valuations need to come down. And for a time period, not a lot of deals were happening. A game of chicken was being played. And the good news for everybody out there is that founders won. The one cardinal sin of private equity is not to put your money to work. Your limited partners, they commit, massive amounts of capital, and they give it to you, and they can't put it in the stock market and earn 8% on average over an extended time period. They give it to you. It's illiquid. It's tied up for 10 years. You damn well better put it to work, because their expectation is I'm going to get twice or better the stock market type returns on that capital. So not buying is a cardinal sin that can prevent a PE firm from raising its next fund and cause them to go out of business. And so this game of chicken could be played strategically, but not for very long, because at the end of the day, money's got to get put to work. And so what will happen is companies that were purchased in a higher interest rate environment, now using bigger equity checks, funds that are of that vintage that include that kind of activity, they'll all have somewhat moderated returns, but they'll be compared against each other. And so they'll all have somewhat moderated returns. But as interest rates come down or normalize, we're expecting a 1 point drop still between now and the end of the year. So, roughly half a point in September, half a point by the end of the year. As rates kind of normalize to a Fed's fund rate of around 5%, 5.5%, deal volume has picked up for sure, because money has to be put to work. But I think you'll find more of that balance. Multiples did need to come down just a little bit. And at the same time, there's so much capital looking for deals to buy that's keeping an aggressive pressure on valuations to hold them high. And so ultimately, I think we're in a normalized period now where PE is used to a little bit higher interest rates. They're writing slightly higher equity checks. They'd like to pay slightly lower multiples, and over time, sometimes they have been successful at getting multiples down a bit. But the asset class as a whole continues to outperform the S&P 500. As a result of that, money keeps pouring in, new funds keep getting formed, or new firms, new funds are coming out. The big firm funds are getting bigger, bigger, and bigger. It's like, geez, the top tier firms, top tier funds now are like 30+ billion in size.
So where does all this money come from, right? Like, everybody's like, oh, private equity. It's like this big mysterious thing. Like, when I look back to before I knew what it really was, it's like they have more money than everybody, right? Private equity, it's the best industry you can be in. But I kind of didn't know what it was before I started reading books on it, like yours, truthfully. And that's how I tracked you down. I pinged you on LinkedIn, and I was like, I usually ping authors, and some of the time they respond, some of the time they don't. And you responded. I was like, oh, this is.
Well, not only that, I've known you for 2 years. We've gone to a World Series baseball game together. It's like, hey, so it's like, that's, I encourage people to reach out to me on LinkedIn, and, I develop friendships with people there. But where the capital comes from, university endowments, university endowments and pension funds, public pension funds. Those are like the two largest sources of LP capital. Then you've got what I'll call a third leg, which is just wealthy people. I'm an LP in multiple PE funds, and wealthy families or people who sold a business, started a family office, and they're not really doing direct investing, or at least not fully, and they're LPs in multiple PE funds. And so it's interesting too, because if you think about how PE firms act, ESG conscious, DEI focused, things like that. Think about where their capital comes from: public pension funds and university endowments. And so they're a reflection of where the money is coming from. But those are the largest sources of capital, to this day. And I think, slowly over time, private equity is becoming more and more accessible to smaller investors. But by nature of having a shelf life of a fund of 10 years and no liquidity, you still need to be an accredited investor. So you have to meet income, levels. You have to have a certain amount of investable cash, in your portfolio, and if you're an accredited investor, you can find PE funds now where you can be an investor, for let's say $1 million as an LP versus what used to traditionally just be 5 million or up. And so there's more and more smaller PE firms that are starting up, and really nice ecosystem. 6 trillion in assets under management, 8,000 plus firms, depending on how you define a firm. The interesting part, though, for most entrepreneurs, doesn't matter whether you buy, or sell, or ever think you're going to sell to private equity. It's because of all the private equity activity and all the capital that we have a market with which we can sell our companies and cash out our chips and make a fortune. Before the world of private equity, the buyer universe was somewhat limited. If I was a small business, I'm hoping to find another entrepreneur who wants to take over my thing and propel it for the next couple of decades. And so the market was smaller, the buyer universe was smaller, prices paid were smaller. Along comes private equity with $6 trillion, buying half the companies sold on the planet, and that has really driven up the prices and the values that are being paid for businesses. And so all entrepreneurs on the globe today benefit from private equity existing and thriving, and whether directly or indirectly, and they have really pretty much created a market from which we can sell.
Who would you consider to be like the originator of private equity?
So you got to go back to the early days, the big boys, like the Bains of the world, the KKRs, the Blackstones. It's like these giant mega firms of today were kind of the early pioneers of yesteryear. And, I've heard so many like Mitt Romney stories about him saying, hey, there's a bubble in PE back in the 1980s. And at some point it's going to burst. And it's like, that was 50 years ago. And it never took a pause. We've just gone steady increase in firms, steady increase in capital and assets under management. It's like, it's an asset class that keeps on morphing and reinventing itself, and getting involved virtually in every industry on the planet now.
Well, you've obviously been in it longer than me. Have you ever seen a dip in private equity, or has it just been growing?
I've seen varying degrees of growth. I can't honestly say I've ever seen a period where, it dipped. I'm trying to think back to 08, 09. Was there any kind of little dip or little pause? Even when there was a dip and a moderation in returns, the returns were still beating, call it the S&P 500. So I think if you looked at it just from a distance, all lines are straight up and to the right. If you get really close to it, there is volatility that's been in it, but the long-term sustained trajectory is, I remember when I first started in the world of private equity, which is, 20 some odd years ago, at that time in history, there was less than $1 trillion in assets under management. I think the number was around 800 billion. And there was like 1,500 firms in existence at the time. Now you're at $6 trillion. When I wrote the private equity playbook, I wrote it in 2018. It came out in early 2019. There were 2.83 trillion in assets under management at that time. We've more than doubled that, in just the last 5 years. And so the growth of capital in private equity has not just been up and to the right, it's been up and to the right and accelerated. over the last 20
And why do you think that is?
Because the returns have been there. Look, if I'm an investor and I know I can do what Warren Buffett says and tells his wife to do when he passes away, put it all in an S&P 500 index fund, and clip a coupon, you're going to get 8% a year, over an extended time period, on average over a 30-year period. It's like, but if I'm in private equity, it's double that.
Yeah.
So in a good
But
year,
you have to be an accredited investor.
Typically, to be an investor in private equity, you need to be a accredited investor. The one subset that is not the case is venture capital. And in venture capital, I see it, all the time. People reach out to me and say, hey, like a family member, a cousin or somebody reaches out. Hey, Adam, I know you're the private equity guy. Here's a prospectus for a VC fund. I'm thinking about betting the farm. It's like, I got $100,000 in my 401k, or, like, I don't want to bet it all. It's like, and I read the prospectus and it's like, typical VC fund does not even beat the S&P 500. Typical historically, VC funds just don't do very well. There's a place for them in a diversified portfolio, but I hate to see small investors, because they have access and they can't write the $1 million or $2 million check, they get involved in some type of a venture fund, and the returns just really aren't there historically, and they're typically disappointed. But that's the one area of private equity where you can be a small time investor and find stuff to invest in, for sure. But the traditional PE funds still have high barriers to entry. And just because you have capital doesn't mean they'll let you in.
Right. True. Yeah, because it's private, right?
Yeah.
They could just say they can discriminate, right?
Well, so what happens is people commit money to the funds. Well, let's say they had a hard cap at $1 billion. They wanted to raise $1 billion. Well, if they've got $2 billion in commitments, they get to be selected.
Mm-hmm. So yeah, if people are out there and they're like, okay, I want to, what industries do you think where's the future? Where are the future in these industries in private equity, or is it still kind of the same industries that are hot? Or you think that it's just going to continue?
I think ultimately you can make money in any industry, but there are certain profiles of businesses that do better than others. And so in my book, Empire Builder, I tried to lay it out for people. So if I didn't own a company, what kind of company should I be thinking about looking at to potentially buy? And for me, I like companies that focus on needs, not wants. So I need my roof fixed. I need, when I need something, it's like, it's not discretionary. I want new tires for my monster truck. My wife wants a new outfit. My wife wants a new designer purse. But if I'm broke, unemployed, don't have any money, I can delay all those expenses. So when the economy goes south, market was down 1,000 points yesterday. When the market goes south, companies that are focused on discretionary spending or project-based and not recurrent, then those companies, revenues can drop drastically overnight. There's a volatility. So I tell people, focus on needs, not wants. Focus on contracted revenue versus project-based revenue. Now, I just got done, building a big company in a project-based kind of world. We made a ton of money. So I'm not saying you can't make money anywhere. I'm saying there is a profile where you can stack the odds in your favor. So needs, not wants, contracted revenue, not project-based revenue. Low capital expenditure, high free cash flow. That's important because if I'm a typical small entrepreneur, I don't have any money. I want to buy the company and use the cash flow that's being generated by the company to service the debt and potentially even provide me with income, when I'm doing that. And so, on the blue collar side, I think of things like pest control, landscape maintenance. These are companies where I'll sign a contract and forget about it. The first of the month, that pest control company is literally hitting all their customers' credit cards within 3 days, 100% of their revenues in the bank. Every time they find a new client, it's additive to the pile of revenue they have. If I think about a project-based business, every month I have to reinvent myself. So like I made a lot of money in HVAC. Well, let's say I need a new HVAC system. Well, you're my revenue for this month. But next month, when I wake up and the first of the month hits, I'm no longer billing you. I'm looking for a new client just to get back to the revenue level I had. If it's a recurring revenue, like that pest control, or in professional services, I'll talk about right now. I'm doing a lot of buy and builds and bookkeeping, accounting, payroll type service companies. There's 1.8 million of those kinds of companies in the United States. I'm working on 3 buy and builds right now in that industry, and the margins are fabulous. It's like they have a bunch of clients, they're doing their books every month, and they've got recurring revenue, and they're generating 30+% profit margins. And the IP is your head. It's I'm an accountant, I'm a bookkeeper, and so I don't even have trucks. In a blue collar world like pest control, I got employees, I got trucks. In a bookkeeping and accounting company, I've got the same need not want recurrent revenue versus project, but I also have the product is up here. So I've got a few computers and maybe an office, but I don't have a bunch of trucks I'm buying. So it's even higher margin than. But there are blue collar service companies. There's professional service companies, that kind of meet these criteria. And, I'm looking for companies where I have a very high probability of finding success. And, I've been helping people in different industries now. I've got exposure all over the place, and I'm getting a good look under the hood of several different sectors. And so I'm a fan of service businesses. I know there's a lot of people out there, especially in the tech world, who are trying to create the next great best thing. And I'll tell you, hell, just do something boring and do it well, and you'll make a ton of money. So are we out to, say I'm a tech company founder, or are we out to make money? Again, I need cash flow. I need to generate wealth.
Are you seeing AI in any of these blue collar or
I'm seeing AI everywhere. So,
yeah.
AI is the pet rock of this generation, and it will absolutely help and aid, all companies, as call it the next great transformation of how.
Can you give a specific example? Just curious.
Yeah, I work with a company. So one of the companies that I work with, one of the founders that I work with, owns an AI company that had been developing technology for a decade. So before AI was sexy, they were building an AI-based company that works with lawyers, only lawyers. And so lawyers can't use ChatGPT. They can't call it open architecture platforms to do legal research, to write legal briefs. They have a set of rules that they have to follow. So they built an ecosystem, which is kind of the ChatGPT for lawyers. And so you could be live in a courtroom, prosecuting a case, and the AI thing can be citing case, verse, and precedent, for a certain argument that you're making. You can be doing legal research, and your paralegals or your junior associates can be using a database that has all case law loaded in it. They understand what you're trying to do, and it's a very powerful tool. But it's a confined ecosystem that meets all of the requirements of the legal industry. And so that's an example of an AI company that I'm working with that literally is revenuing with the biggest law firms in the country already. While other people have invested hundreds of millions of dollars, these guys had a 10-year lead, to developing it, and they're actually revenuing today. So I'm seeing AI help in marketing. I'm seeing AI help with digital type marketing efforts, with customer service, with paperwork processing, back office type functions that are repetitive, that aren't efficient for a human to process or to do. So I think we're just scratching the very surface of AI, and so it's a hot area. But I also think that it's going to be a very volatile area. So you've got the big players of the world, the Apples, the Microsofts, the Metas. You've got people who are just literally spending hundreds of millions of dollars on AI technology, Elon Musk. And it's like at some point, small companies, anything you do, you've got a very short window of technical advantage, because eventually the big boys with all the money will swamp you. And so if you're an early adopter, and you have an AI-based company, I would be seeking to monetize it sooner rather than later. If you can build a company that saves Microsoft 6 months of research and development, to them it's worth a fortune, and to you, it's a quick exit with a big number. So certainly AI is touching every industry right now, but we're still learning how to use it.
We got 5 minutes, so I want to get a couple questions in it. But what about every 100 days, the American debt is going up $1 trillion. I read that.
Yeah, this is a problem.
Private equity, and how does it affect private equity executives or the future? What are your thoughts on that?
Well, so at some point, the merry-go-round stops, and at this point, I think we're spending more now on interest than we spend on defense. And the government is just sick. And I'm not being party specific. I'm just saying we cannot continue to spend money that we just don't have. You and I, every month, if we got to pay our bills, we pay them, and it comes out of our bank account. It's like I can't leverage forever. And we as a country, as we continue to over lever, the reason we've gotten away with it is because the world was based on the US dollar as kind of the common trading currency. And at some point, if that ever ends, or the debt just gets so massive, the US government is going to have to do something. And that crash will be gigantic in proportion, epic in proportion, and that will equally destroy a lot of value in the world, not just privately held, or held by private equity, but just in general. It's like at some point you've got a great reset that has to happen, because you can't sustain uncontrolled spending by a government.
I feel like prices are going up on everything, right? Like even from a year ago or 2 years ago, everything is significantly going up. So the more money people are making in private equity, it's like, oh, that's great. It feels like a lot of money, but everything else is going up in price as well.
Yeah.
Just everything across the board.
I remember back, because I'm old enough. I remember back in the late 70s, early, before Ronald Reagan came in 1980. It's like interest, at one point, interest rates to like buy a house were like 15 to 18%, something like that. And inflation was through the roof, much higher than it is today. So I would say that, government overspending during COVID and after COVID certainly drove, the wave of inflation that we're seeing today. And I think long term, the national debt will have a serious negative impact on business.
So what's the solution? Do they just like write it off and file bankruptcy? Do we sell a state? You know what I mean? How do we?
Yeah, I've often joked about that. Well, it's like, God, I'm 60 years old right now. So people in my generation are certainly scrambling as we're looking at Social Security, and baby boomers are aging out. So I was born in 64. So I'm the official last of the baby boomers, and I'm 60. So that means baby boomers are 60 to 80. We're all selling businesses. We're semi-retiring. We're fully retiring. And everyone's looking at Social Security, and it's going to put a huge demand on Social Security. And so it's like everyone's hoping it will be there. If I'm 30 years old today, I'm thinking Social Security as we know it today, it just isn't going to exist, at some point. And I was actually happy to turn 60 and say, okay, I'm a wealthy guy, but still I've been paying into that system my whole life, and I want
what you're saying is prepare for a life without Social Security for everybody that is like 20 to 40.
Yes. Generate your own wealth,
but how much is that going to shave off of the 30 trillion in US debt, right?
Probably nothing, right? So it's like some politician 30 years from now will just create a $100 trillion bill, and they'll hand it to creditors and say, here you go, we're paid in full.
Yeah. So how does that issue get solved, Adam Coffey? How do we solve that issue?
Boy, Andrew, it's like there ain't enough time on this podcast left for you and I to solve that issue. That's for sure. So I hope people smarter than us,
but it's not. We are the they, right? I think personal growth
with fiscal responsibility.
Yes.
We cannot spend money we don't have. We cannot be a country, of handouts.
And that's what happens when you have politicians running the country instead of business people running the country.
Correct.
Right? Yeah. They don't know how to manage it. And that's been a problem.
America never has been a place that guarantees success. It guarantees the opportunity to pursue happiness, and success. And so, we can't be a nation of handouts. The government cannot fix every problem of its people. There's just not enough money. And so it starts with fiscal responsibility. I'd love to see things like a line item veto, a balanced budget amendment. It's like force politicians to balance their checkbook like you and I have to every month. That's where it starts. Starts by stopping the insanity of the spending. and learning how to live within our means day to day, and then learning how to generate surplus to start paying down that debt.
Got to take 2 steps back, maybe, to take 1 step forward. All right. Thanks, Adam Coffey. I know you had a hard stop. Go get his books. They're on Amazon. Exit Strategy Playbook, Private Equity Playbook. Best books I've ever read. Reach out to him on LinkedIn for coaching or his group. And we appreciate you, Adam.
Thank you, Andrew. And thank you to everybody out